Next point, simple technical analysis. Other options trading strategies and stock trading require intense fundamental and technical analysis, significant understanding of the market, and the ability to beat the news. Selling credit spreads needs a very simple trend analysis procedure, which should not take longer than 10 minutes a day, and the ability to plan for upcoming events such as earnings reports. Well, technical analysis can certainly be simple. Most traders use statistical probability and select strikes at certain standard deviations away from the current price, or simple support and resistance. But one must never forget that technical analysis is arguably a coin toss. Statistical probability and support or resistance doesn't guarantee the price will stay above that level. At best, it is a hypothesis, and markets have fat tails. So price can certainly run straight past the most finely crafted technical level and not even wave as it goes by. But finding statistically high probability trades with the odds in your favor can be a very time-consuming pastime. As we've already discussed, probability is only half the story, and for long-term profitability, we need to have favorable prices. This takes very much longer than 10 minutes a day. You are in effect being a bookmaker. It's a serious business, and your money is at stake, and it deserves more than the time it takes to have a cup of coffee. Make sure the odds are in your favor. The penultimate point is time spent in monitoring the trade is very low. This can be true if the trade is properly constructed and the trade behaves as anticipated and hoped for. Credit spreads can be very low maintenance if all goes to plan. But what if things don't go to plan? Do you sit it out and hope it comes back with the chance of a maximum loss? Do you try to adjust? Do you exit with the possibility of the trade coming good after you've crystallized a loss? How closely are you going to watch the trade under these circumstances? These are questions one should ask themselves before accepting the low maintenance line. Finally, we have the author's last point. Profits range between 5 and 20% per month, depending on how actively the spreads are traded. Compounded, this leads to significant growth in a profile. Starting with $1,000 and gaining a steady but sure 15% per month, you can get your first $1 million in 4 years without deductions for ulcer treatment. Well, 15% per month shows me that the author has a very high risk of ruin. Why do I say that? If we go back to our example of a high probability credit spread earlier on in this video, we will see that the $260 profit is set against a $1,740 risk, with that amount as a minimum margin required if trader has risk margining. Starting with a small amount of money is indicated, risk margining would not be available, and margin would be $2,000 in this example. That's a return of either 13 or 15%, depending on whether the trader is on regulation T or risk margining. Many high probability spreads would be less than this. If profit was higher than this, it is set against a lower probability usually. What it shows is that for this trader to be showing 15 to 20% profit per month, it means he is placing his entire capital at risk each month. A maximum loss will wipe out his entire capital. Even if diversified, an adverse broad market move is going to take out the majority of his capital, and it is only really a matter of time before something like that happens. The compounding argument is fallacious, as it does not take into account losses, mathematical expectancy, and real-world bottom-line results over long periods. The mathematics just don't add up here. And I'm not saying it's impossible. Heck, some people come out of Vegas as millionaires, but the odds are not in your favor of this occurring with bull-put spreads. And risking your entire capital like this will almost certainly blow up your account at some stage. Lastly, those losses don't come all neatly packaged. You don't win 8 or 9 trades in a row and then lose the last 1 or 2. The maximum loss might come on your first or second trade before you can afford to diversify. You could be out of the game before you even get going. After all that negative, however, credit spreads are a very good strategy. I have nothing against the strategy if applied correctly, the risk understood and properly position sized. They do have their place in any option trader's arsenal of trades. If you are convinced that the stock is not about to go on a moonshot, and you are as certain as you can reasonably be that the stock will hold support above the sold strike. In other words, you think the stock is going to flounder about roughly about where it's at, the bull put spread is just the ticket. Ideal under those circumstances. Or if you have no idea where the stock will go, but you are pretty sure where it won't go, again it is perfect, so long as the odds are in your favor, mathematically, and that means getting a reasonable credit that statistically has the sum of your dollar wins greater than your dollar sum of losses. But remember, it is just one strategy in a toolbox of many tools. There is always the possibility that there is a better strategy under the particular circumstances. That possibility should always be examined. Use other strategies when appropriate. And if you do go for the credit spread, do the sums. Make sure the odds are on your side. Use them wisely and in the right circumstances. Lastly, beware of hype. There is just so much nonsense out there in option land. You know, options truly are an incredible investing and trading tool, but when labouring under erroneous information from hypesters, they can turn into weapons of mass financial destruction. Yours. The key is correct knowledge and correct thinking and correct position sizing. Seek the truth of those three things and you have a high chance of being a winner in this game. Well, that's it. Thanks for listening, and I hope you got something worthwhile from this video.